Before we begin, just want to let you know that I am not an investment or financial advisor, and these videos are for entertainment purposes only. Hey, what's up everyone? I hope you guys are all having a great day so far. This is going to be a video on the Greeks. I'm going to explain to you guys what each of them mean and how important it is to understand them before you get into an option contract. So before I get into it, just want to ask you guys, go ahead and give this video a like and subscribe to the channel. Alright, so the Greeks. Me personally, I pay a lot of attention to delta and theta, so I'll talk about theta in a bit, but first let's get started with delta. So delta basically is how much the price of the contract changes per $1 movement in the price of the stock, right? So that basically means, as you guys can see, I'm using Apple and the current share price is $115.60. So if this shoots up to $116.60, the price of the contract is going to increase by this value in the delta section, right? So that's all what that means. So like I said, I pay a lot of attention to delta when opening a call or a put, just because so I know how much how much profit I can get every time a stock or a share price goes up $1, right? So that's per dollar how much it's going to go up by based on this value. So if it goes up by $2, you're looking at about 0.9 increase in the contract price. All right, gamma. So gamma is how much the delta will change per $1 move in the price of the stock, right? So for example, gamma is currently 0.0287, right? So if Apple goes up to 116.98, gamma delta is going to change by the gamma value, which is 0.0287, right? So those are linked together, right? And just want you guys to remember, these are constantly changing, right? Just like how the stock price is changing, the Greeks are constantly changing. That's why I'm recording this video during live trading hours, so you guys know that the Greeks never stay the same. All right, so let's move on to theta. Told you guys this is another important one that I look at. So theta, just want you guys, so first of all, theta is time decay. So just want you guys to remember it as basically a fee that you pay every day to keep the option open, right? And that's going to depend on what the expiration date is. So the longer you have the expiration date out to, like for example, if you have expiration if you have a contract expiring a few months out, the theta is going to be lower than a contract you have expiring, let's say, like 2 weeks out, right? So that just depends on how much risk you want to take choosing the expiration date. I usually just every time I do a contract or open a call or put, I usually at least go 3 to 4 weeks out, right? So that just depends how much risk you want to take, if you're day trading or if you're swing trading. Just depends on your strategy. So I'll let you decide. All right, let's talk about VEGA. So VEGA is basically how much the contract price will move based on implied volatility. As you can see, Apple implied volatility, the IV is pretty high today just because actually Apple has earnings after hours. So pretty high IV right there. So VEGA is just saying that, hey, I'm going to move based on a 1% move on the IV. All right, last one is RO. RO is linked to the open interest. So just want you guys to remember it changes along with the open interest value. To be honest, I don't pay a lot of attention to RO. I think it's pretty insignificant, but that's for you guys to decide, what you guys want to do, how you guys want to play options. Like I said, I pay a lot of attention to delta and theta. So hope you guys really gained something from this video. Hope you guys learned exactly what the Greeks are. If you guys have a question or a comment, go ahead and leave it in the comment section below. Definitely want to hear from you guys what you guys think on the video or stocks and options in general. And don't forget to like the video and subscribe to the channel. Thanks for watching.